Hi, hello, welcome friends. In this video, I am going to discuss about accounting and reporting of financial instruments. So, financial instrument related chapter. So, in this video, we will discuss some financial assets, financial liabilities, and how we can measure, how we can reclassify the measures and accounting principles and hedge items, hedge accounting related information. These all concepts will be discussed. Totally, this chapter will be divided into 7 units. So, we will also cover unit different segments in different videos for different chapters. So it is better for understanding, first chapter what is there, second chapter what is there, unit 6 we have hedge accounting, and unit 7 we have disclosure. So we need to cover 3 Indian assets here. One is India is 32. Here India is 32 means financial instruments, that is presentation. India is 109, that is financial instruments, and India is 107 financial instrument disclosure. So presentations and disclosures and recognition. What is the recognition? In recognition we have 4 categories. One is classification of financial assets and financial liabilities. We need to know the what is financial asset, what is financial liabilities. Next we will how to measure this financial assets and financial liabilities, and presentation of gain or loss in financial instruments, and impairments and recognition and de-recognition of financial assets and financial liabilities. After that we will discuss about derivatives and hedge accounting. Here in India year 32 we will discuss about definitions, classification of versus or liabilities or equity, compounding financial instruments, offsetting of financial assets and financial liability, and its presentation. So these are the topics we will discuss in the India year 132, India year 109, India year 107. So in year 32 it will related to financial instruments presentation. India year 109 it is related to financial instruments. India year 37 you need to disclose financial instruments disclosure related. So we will start with unit 1. In unit 1 we will discuss about financial instruments scopes and some definitions. What is the financial asset, what is the financial liabilities, what is the related. So here the company, what is here landscape, here it will be Indian economy. Here I will discuss. So in Indian economy more liberalization will be there, so more funding will be rising in national. So funds are rising from different markets. So market may be international markets, and different forms we are raising the money. So companies are always expanding their investors time and their cautions. So here we are in depositing that amounts, or we are investing in investment objective will be different funds will be there. For if we want a fixed return, for fixed return we are investing in debt returns. For fixed we are going for debt, and if you want for residual ratios, that net assets like equity or both. Here some special type of investment instruments also there. That special type of instrument will be convertible preference shares and FCCB foreign currency convertible bonds and foreign currency loans and debt syndication arrangements. So this is the introduction they have discussed about here. What is there in discussion? So after that MCA notify, that is Minister of Corporate Affairs, notify the following India years to deal with accounting financial instruments. There are 3 India years as well disclosed notified by MCA. One is 109 and one next is 1032, that is financial instrument presentation, and 107 financial instruments disclosure. So these 3 will discuss about relating to financial instruments. Here the financial instruments mostly the guidance will be from IFRS. So here classification of financial instruments will require substance of agreement and between the parties and the legal form and financial assets, whatever the financial asset meaning and definition of financial assets, financial liabilities and equity, recognition, measurement and criteria will be classification of such instruments. So now first what is known as financial instruments. So financial instruments means come here. So financial instruments it is one contract. Here there will be one contract. So contract will be to raise financial assets. So to raise financial assets of one entity, and another entity will increase financial liability or equity. This is known as financial instruments. Here what will be the definition? One financial instruments means is there in one contract and it will give rise to financial assets to one entity and financial liability to other equity. Here the contract means what? Here the highlighted words, broad words. So financial contract means what, financial asset means what, financial liability means what, equity instruments is what. So contract means it is an one agreement between two parties. So here there will be one party and here one will be two parties. So in between these parties there will be agreement, that is known as contract. It is clearly specify the what are the bonds will be there, what are the condition will be there, and this contract will be enforceable by law. And contract may be in does not require always in writing, it may in variety forms also. So important will be any assets or liabilities not contractually or not financially liabilities. This is the definition of contracts. So need not in writing and may variety of forms will be there, and contract may be between two parties. So there may be any assets or liabilities not contractually. So income tax liabilities, that is statutory obligations not rising from contracts. So some cases this in tax liabilities or statutory liabilities there is no contract but they will arise. So some cases it will be constructive obligation will be there. And here contingent assets and contingent liabilities also required. Here contingent assets, contingent liability do not rise from contract, so hence are not financial liabilities. So always these contingent liabilities, contingent assets are not a financial liabilities. And here financial instruments will include two types. One is primary and one other one is derivative financial instruments. In primary we have receivables, payables and equity, and whereas derivative financial instrument we have financials, options, futures, forwards and interest rate swaps and currency rate swaps and total return swap. Example we will provide in the later cases. So now firstly we have discussed about financial instruments. Financial instruments means it is an contract. Here one party will get the asset, financial asset, and another party will get the financial liability and equity instruments. Here the contract means the agreement between the two parties. Agreement may be, it will be enforceable by law, and agreement may be in writing or in any variety form. There may be some cases there is no assets and liabilities, that will not be contractual obligations. So they may rise from constructive obligations like these statutory liabilities, income taxes, and where these contingent liabilities and contingent liabilities does not a financial liabilities. Here financial instruments broadly classified into two categories. One is primary instruments, another one is derivative instruments. So whatever in your balance sheet, in the balance sheet if you see receivables, if you see payables, or if you see equity instruments, these are primary instruments only. And some derivative instruments are financial options, financial futures, financial forwards, interest rates. Example they will be there. Now we should know about the financial assets. So financial assets means what is there in financial assets. So in balance sheet, here in the balance sheet side, what is there in asset side? So we will go with the cash. So cash is the first item. Any asset that is cash, it will be cash. Or if you invested in any equity instruments, that also come under financial assets. If you have any right, so if you got the any contractual right, that also it will come. Here contractual right means they may right to get the cash or right to receive any financial assets or under the configuration. So if you have any derivative contracts, it will come under the financial assets only. So in financial assets we will get cash and other equity instruments where you in other invested in other entity, and some contractual rights. So contractual rights means you have right to receive or another financial asset from another entity. It is also one contractual right. Or to exchange financial asset or financial liability with another entity, and the condition will be potentially favorable to the entity. So it is favorable to our entity, then also it is contractual right. After that contract will or may be settled in entity's own equity instruments. So for some cases entities will settle in your own equity instruments. It is contract only. Here financial assets means cash, equity instruments, contractual rights, and some entities own equity instruments. That is, entities own equity instruments means it may be non-derivative, so which are entity may have obligated to receive variable number. So we will must know this variable number of entities own equity instruments, that is non-derivative. And derivative means that will be settled other than fixed amount of cash or other financial assets of fixed number of own equity instruments. For example, if you see here one example, so here if you see one example, there may be one entity equity own instruments will be not be puttable financial instruments, it will be classified as equity instruments. One entity is there, it has own equity instruments, it do not included in the fixed amount, so it do not include the puttable options. So puttable options is not there, means puttable means it is bare. I think some disturbance is there, no? So whether we can continue or not, we can continue. Just a second, give me a second. So here they will provided some examples for financial assets. So what is included in financial assets? In financial assets we have cash, trade receivables. If we invested in any bonds or deposits or investment in equity instruments or loans receivable, these all are financial assets. So if we see in the balance sheet, it will be asset side related cases, that are all financial assets. Here what is mean by cash and what is mean by contractual rights to receive cash or other assets. So cash means any currency, it may be currency or in the financial assets, that is medium of exchange, and it's there on basis of all transactions method recognized in the financial statement. So it is currency, whatever the currency. If you have rupees, it will be currency. If you have USDs, it will be currency. Whatever the amount, cash and cash equivalent. If we see in the balance sheet, we have some cash and cash equivalent. That cash and cash equivalent is known as cash. And if you deposited your money in with the bank or any financial instrument, that also known as cash only. And after that, contractual right to receive cash or other financial assets. So if you sold something to some fixed assets or some goods, then you will receivable from that person. So then also it is known as contractual obligation right to receive it there. When you have right to receive, it will be contractual right to receive cash, it will become also financial assets. So common examples are trade receivables, loans and notes receivables, deposits made and investments in bonds, etc., etc. Here these are all included in financial assets only, and these are bifurcation will be contractual right to receive in cash. So right to receive in cash also included in financial assets. After that, some contingent rights and obligations which meet the financial assets and financial liability. So even two such assets and liabilities are not always recognized in the financial statement. For example, here what will be there, one person is there, one lender is there, and he provided one financial guarantee to another person, he will be guarantor, one another person is guarantor on behalf of the borrower. So borrower will be there, on behalf of this borrower he given one guarantor, so he given one guarantee on behalf of this borrower, so entitling to recover outstanding dues from the guarantor. So when this person is not paying, from guarantor bank will get that amount, outstanding dues will be collected from that person. So here the India 37 deals, that is India 37 deals provisions contingent liabilities and contingent assets. So it will excluded in the scope of financial instrument within the India 109. So it will be financial guarantee contract cannot be disclosed as contingent liability. So we have discussed that here in financial contingent liabilities and contingent assets do not arise from contract and hence not financial liabilities. So it is not financial liabilities, it is not financial liabilities. And after that we need to disclose that what is the physical assets, what is the right to use we have. So physical assets, right to use, or intangible assets. So physical assets means it is intangible assets like inventories, PPE, and which have ROU. ROU we can use in India AS 116, that is leases cases. We will use the ROU, right to use. And intangible assets as such as patent, trademarks, these all are not a financial assets. So whatever the physical asset we have, whatever the right to use we have, whatever the intangible assets we have, it does not become the financial assets. Next, control of such physical assets, right to use assets, and intangible assets create an opportunity to generate inflow of cash or another financial asset. So but it does not give rise to present right to receive cash or other financial assets. So if you have any right to get these items also, it will not become the financial assets, because these are not firstly financial assets. And after that, some prepaid expenses. Prepaid expenses means whatever the expenses paid in earlier, it will become prepaid expenses. Prepaid expenses means in assets. So assets such as prepaid expenses for which future economic benefits either receipt of goods or services rather than right to receive or another financial assets. So prepaid expenses will be whatever the expenses was incurred next year but paid in earlier. So if you have any cash, you are paying early for that person, then it will become the prepaid expenses, it will become the assets. And after that, it's similar such as this deferred revenues and most warranty obligations are not financial liabilities, because the outflow of economic benefits associated with them of delivery of goods and services rather than contractual obligation to pay cash or another financial assets. And perpetual debt instruments. So perpetual debt instruments means perpetual bonds or debentures, and here capital notes also will be included in here cases. So normally these providers will get the contractual right to receive the payment on account of interest at a fixed dates. So they will be semi annually or quarterly, they will pay the fixed interest, and this will be indefinite future. When perpetual means it have indefinite future, either it may with no right to receive the return of principal or right to receive the principal under the terms of the one were unlikely or likely to the future. Some examples was provided relating to financial assets. So we need to whether the asset will be financial assets or not, we will need to identify that cases. Here some items. So first item will be investment in bonds. So we are discussing that investment in bonds, equity, it will become the financial assets. So here we will get the contractual right to receive in cash, so it will become the financial assets. After that, loans and receivables. So loans and receivables will be financial assets, means here we will get the contractual right to receive cash, so it will become the financial assets. Next, deposits given. So here deposits given means we will get the right to receive, so it will become the financial assets. And trades and other receivables. So receivables means we will right to get the cash, so it will also financial assets. Cash and cash equivalents, it is also financial assets, which specifically covered in the definitions. So we taken in financial assets, first we start with cash only. So cash and which have contractual right to receive. So here we have this all are contractual right to receive, so that we are specifying in the financial assets. And bank balance is financial assets, where contractual right to receive cash will be there. Where if you invest in equity shares, so if you are investing in equity shares, in equity is a another entity, it will also financial assets. And perpetual debt instruments. So last example we have taken that perpetual debt instruments only. Example here perpetual bonds, debentures and capital notes, it will also financial assets. So such instruments provide contractual right to receive interest for a indefinite future, so indefinite future. And here the right to return the principal may be under the terms, it may be likely or unlikely. And physical assets means this inventory, property, plants and equipment, it will not be a financial asset. So here the contract of control of such assets does not create a present right to receive cash or another financial asset. Here we will get the ownership or we will get the control on that assets, but we will not get any cash or any other financial assets. By using that assets we will generate the cash, so that directly they will not provide the cash. Next, right to use assets. So example, lease vehicles. So lease vehicles also not a asset, so it will deal on India is 116, that is leases. And here inventory means India is 2. PPE means that property, plant and equipment, that is India is 16, it will deal. And control of such assets does not create any present right to receive or cash or another fixed financial assets. After that, intangible assets. India is 36, I think so, and it will also the trademarks, patents. So here also we will not get any cash. So control of such asset does not create any a present right to receive cash or another financial assets. Prepaid expenses, prepaid insurance or prepaid rents means it is asset for future assets. We are for expenditure, for future expenditure we are paid now itself, so we will not get any cash here. So no, it is also not a financial asset. These instruments provide future economic benefit in the form of goods or services rather than right to receive. So if you paid some prepaid expenses, if you paid some amount to you creditors, so you will get the goods. So if you paid the rent in advance, you will get that service only, you will not get any financial assets or cash. So only when we are getting cash or financial assets or right to receive financial assets, then only it will become the financial assets. Advance given for goods or services, so it is also not a financial asset, because here we will not get any right to cash, right to receive cash. So they provided some one illustration. In illustration 1, A limited, here one person is there, so he is sell some goods and given credit for 45 days, and here customer will get the 2% discount if he paid before this 45 days, and if after 25 days he will to pay that another 10% of after 45 days. So evaluate whether such trade receivables are financial assets or not. We know that trade receivables are financial assets, because the financial asset means what? Financial asset means here one asset where the contractual right to receive cash or another financial asset from another entity, it will become a financial asset. So simply financial assets means we need to get another financial assets or cash from another entry, then it will become the financial assets. So here the above case, A limited has contractual right to receive cash or bank from trade payables, so trade receivables. So trade receivables always will be a financial assets recorded in its books of accounts after expiry of the credit period of 45 days or early after passing of discount 2% per annum. So here the trade receivables would meet the definition of financial assets. It to be noted that contractual right to receive cash includes contractual right to receipt of money in bank account or any wallet. So if they told that you will receive in Paytm wallet or Paytm wallet or phone pay wallet, it is also known as cash only. And after that, second one, here one company is there, you also Jet company is there, he sold some goods and credit basis, and here one amount what that amount they are sending one large vehicle, and for that they will collecting some fixed deposit, so security deposit, and for that amount will be 10,000 rupees will be the security deposit, and they will pay the 8% interest on that security deposit when the contract is submitted. If the container are returned by the dealer in broken condition or any damaged cause, then appropriate adjustment shall be made from the deposit. So if he is sending one vehicle, after he reached it was not came as it is, then they will charge some amount, they will adjust on this deposit amount whether it will be financial assets or not. So it is a financial asset. So here financial asset is asset where you will get the contractual right to receive cash or another financial asset from the another entity. So in here if we are getting such security deposit has receivable in cash at the end of the contract period and between the dealer and the company, here it will meet the financial assets definition. After that we have financial liability. Financial liability means in financial assets we have cash and contractual rights, where in financial liability we will have contractual obligations. So contractual obligation, here contractual obligation means delivery cash. So we will deliver the cash or financial assets to another entity. Here we will deliver cash or other financial assets to another entity, or we will exchange from financial assets or financial liability so to another entity. In a, there will be conditions will be unfavorable to the entity when there is the unconditional unfavorable potential to of the entity. It will become the contractual obligation, or we can say that a quantity will or may be settled in entity's own equity instruments, and is there, so it is settling by it is paying, or it has obligation by paying its own equity instrument, then it will become the financial liability. So it may pay in a cash form, or it may settle in own equity instruments by selling the own equity settlements. Here the non-derivatives for the which an entity may or may be obligated to deliver variable number of equity instruments. So this is very important, because why variable? So if you go for the fixed, it will become the equity. If you go for the variable, it will become the variable. So variable, it will become the contractual liability. So when variable, it will become the financial liability. What is the logic here? So logic will be simple. If it is a fixed equity instrument, and amount for the equity instrument we need to pay as per the market value. If the market value is changing and equity also changing, so when there is a risk, it will become the equity. But here variable number of equity instruments. So in variable number of equity instruments means here the market value amount was fixed, 10 lakhs will be the amount. For example, amount was fixed 10 lakh rupees. So for this we need to give the shares, equity shares. It may be 2 lakhs, it may be 5 lakhs, it will depend on it. It is variable case, and the shares may variable. But if we fixed the equity number of shares, if we fixed 2 lakh shares, when the market price is different and market price is increasing, here the risk will be more, so it will become the equity. When it is variable, it will become the financial liability. And derivative that will arise or may be settled other than exchange of fixed amount of cash or another financial assets for fixed number of entities own equity instruments. In case of delivery, it will be different. For example, for purpose they have provided some in derivative we have different options, that is forwards, futures, options, rights, swaps, warranties will be there for a year. So if we providing the rights or options or warrants, so here rights means they will give at a lesser price to extend some persons. Warrant means they will give the option and they will must exercise that option and acquire the fixed number of entities own equity instrument for a fixed amount. So here the amount will be fixed. Amount will be fixed means shares may change, it will not a problem. If the shares was fixed shares, then risk will arise, then it will become the equity share. So we have financial liability and equity. We will discuss it later after the completion of this financial liability, that is cases. So as the exception, following types of instruments, they provided some common examples for financial liability. So financial liabilities will include loans and borrowings. So whatever, if you want any money from the bank, you will get the loan and you will borrowing from the bank. And payables for purchase of goods and services. So if you are purchasing some goods or services, you need to pay, so that will be financial liability. And financial lease liability, that is India is 116. If you have any lease that is payable, that is financial lease liability, it will also financial liability. And redeemable instruments like prefers, debentures, etc., it is also financial liability. And guarantees given for repayment of debt upon borrower's default, it will also financial liability. So what are the financial liabilities? It will be loans and borrowings and payables and financial lease liabilities and redeemable preference shares or debentures are guarantee given for repayment of debt upon borrower's default. It all known as financial liabilities. So now we will know evaluate the financial liability, whether this will be financial liability or not. So loans payable or banks, so if you taken from the bank loan from the bank, it will be financial liability. So contractual obligation to pay cash is there, and trade and other payables, it is financial liability only. So whatever the current liabilities will be there, for that contractual obligation to pay cash is for trade and other payables. Bills payable are acceptance, so financial liability it also. So contractual obligation to pay cash will be arises when you have bills payable, you need to pay in cash. Deposits received, so if you receive some deposit, you need to pay that person, so it is also financial liability. If you are here, we have contractual obligation to pay cash. If you have contractual right to receive cash, it will become financial assets. Contractual right to obligation to pay cash, it will become the financial liability. And mandatory redeemable preference shares, so if you need to pay when shares are redeemable, so preference shares is redeeming, then you need to pay the cash, it will become the financial liability. And financial guarantee, so if you given any financial guarantee, it will become financial liability. Contractual obligation to pay cash due to occurrence of such an event, or perpetual debt instruments. So for they provided some example here. One company is there, a company is there, and it has issued some bonds. Bonds was issued, and here the term of the bonds will require some annual payments, that is in perpetuity, that stated coupon payment. So 8% they are paying interest. So it is perpetual, means it does not have maturity at a certain period, so they will decide maturity payable or not. So they will pay continuously interest, they will pay the interest amount. And here they will issue us assume the contractual obligation what is there, and makes term future interest payments having some fair value. And fair value, so payable futurely contractual obligation interest payment having fair value present value of CU 10,000. So it will financial asset. A financial asset means what? Financial asset means one asset where you will get the contractual right to receive or another financial asset from another entity. If you study the financial liability definition, financial liability means where you have contractual right, contractual obligation to pay, that only. It does not include the contractual obligation to another financial liability. So only financial assets is an asset where there is contractual right to receive cash or another financial asset from another entity. It only financial assets. Here some person will be there, one person is holder and one person will be issuer. Here holder will get the right to receive cash in future, so he is classified as financial assets. Whenever the person he is getting right, he will recorded as financial assets. Whenever the person is obligation to pay cash in future, he will be the issuer. And here however the instrument is redeemed at the option of A Limited, because it is perpetual means there is no maturity. So here the option will be there for that company only, so the company may pay at the time of liquidation. So therefore the instrument characteristic has both equity and financial liability. So such as instruments is regarded as compounded financial instrument. So when one instrument has both options, that is it has nature of equity and it has nature of debt also, then it will become the compounded financial instruments. And for credit for sale, here some company is there, so A Limited is there, and he is purchased some goods in normal business. So from B he has purchased some goods. So here the payments, so he will pay in 30 days, and interest will be 12% if he has paid later. So it also మనం see in contractual assets. So here reverse cases. So here purchase in contract financial assets we have seen in sales. And financial liability means here any liability where contractual obligation to deliver cash or other financial asset to another entity, then it will become the financial liability. And here A is entered one contractual agreement. So contract means was there is agreement between the two person. It will become maybe it will be enforceable as per law, and it may be in writing or in any form. It is known as financial contract. So here one contractual arrangement will be there, that is purchase of goods at a fixed consideration payable to the creditor, and a contractual arrangement that provides for pay in fixed amount of cash to another entity meet the definition. So it may be interest payable or not payable, but that principal amount is compulsory payable now, so it will become the financial liability. After that, one question, a limited company is there, and here the company is borrowing some money from bank. So here the amount will be 10 lakhs amount will be, and 10 lakhs will be payable at the rate of 12% interest per annum. Annual interest rate will be 12%. Now company is defaulted at the end of 5th year, so 5th year they are not paid, and consequently this 10 lakhs amount was rescheduled. So at the beginning of the 6th year they need to pay 130, so 1 lakh, so 13 lakhs, so they need to pay 13 lakhs. So at the time of initially they need to pay 10 lakhs, and they need to pay annual interest 12%, but at the end of the 5th year they are defaulted, so they need to pay at the amount 13 lakhs, and end of the 6th year for one time settlement. So they are going for one time settlements, means within 1 year they need to pay. It will become the current only. And here the firstly A Limited has one arrangement. So firstly the instruments lead definition of financial liability. So for financial liability, A Limited has one contractual obligation because they need to pay the payment, because the payment may include principal plus interest, so it will meet the financial liability. Whenever you need to pay some cash, it will become the financial liability. Now compute the amount required to be settled and any differential arising time of settlement. So here the loan amount will be 10 lakhs firstly, and amount payable at the end of the year, end of the 6th year will be, what is the amount? Firstly 10 lakhs into how much the interest rate, 12%, means 1 plus 12% rate, 1 plus 12% rate for 2 years, for 5th year and 6th year end they are paying, means 5th year plus 6th year, it will 2 years interest will be calculated, and for that we have got the 12,54,000 actually if we pay without, but they are getting for one time settlement 13 lakhs, so there is additional amount is payable for 45,600. Here the additional amount, the above referent, is a contractual obligation to pay cash against settlement of financial liability under a condition that are unfavorable to A, because they are unfavorable to A, because they are principal is one amount 10 lakhs and interest rate is 12%, but they are charging more amount than what they are increased, and here the ends the reschedule arrangement meet the definition of financial liability. Even though that reschedulement is there, they have obligation to pay cash, so when obligation is to pay cash, it will become the financial liability. After that we need to know about the equity instruments. So in what is equity instrument? So we have started with the financial assets. After the completion we have seen that financial liability. Now we need to see that equity instruments. Equity instruments means any contract that evidence a residential interest in the assets of an entity after deducting all its liabilities. So here assets and liabilities we have. So in asset liabilities, whatever the liabilities will be there, after deducting all liabilities, whatever the amount there, that will become the equity. So here equity means after deducting all amounts, then it will become the liability or equity amount. Here an instrument, equity instrument, if and only if both conditions will be satisfied. So two conditions. So financial liability means they have contractual obligations, so that opposite side means no contractual obligation, then it will become the equity, means there is no delivery cash or another financial asset to another entity, then it will become the equity. Or to exchange financial assets or financial liability with another entity under a condition that are potential unfavorable to the issuer. This is no contractual obligation, then it will become the equity. And another one will be issuer's own equity instruments. Here we need to see when issuing own equity, here also own number of equity, but here fixed number of its own equity instruments, fixed amount or cash amount for the purpose of rights, options, contractual obligation, they will be existed. And the obligation what is there in equity, we have some examples. So in equity, whatever the equity instruments issued, it will become equity. And warrants to issue, that is fixed number of shares at fixed price against each warrant, it is also known as equity. And other instruments, that is convertible into fixed number of equity shares for fixed amount per share, it is also known as equity. Here the key characteristics, what are the key characteristics for equity instruments? We have key contractual obligation. So when we do not have any contractual obligation, then it will become the equity. When if we have contractual obligation, it will become the financial liability. And here key characteristics of equity instruments will be, there is no contractual obligation throughout any payment or distribution. So in middle also they will not get any obligation. And however, the following type of instrument has exceptions or equity. For they have puttable financial instruments. That is, when puttable financial instruments means it is a bearish market instruments, so that are exempted. Financial assets provides at requisite criteria, or some instruments or component of an instrument that contains an obligation for issuing entity to deliver to the holder or pro rata shares of net assets in at the time of liquidations. These are all exceptions for the equity. Here the nature of this instrument and criteria to be meet the equity classification, but greater deal it will be financial. We will deal in unit 3. What is this nature? This nature will be spell that equity, but it will be recorded in different way. We will discuss it in unit 3. Next is settlement in own equity instruments. Here settlement in own equity instruments is equity classified only if it is fixed for fixed transactions. If you have variable, it will be financial liability. If you have fixed for fixed transaction, it will be equity portion. Here issue of fixed number of shares and involve fixed amount of cash or other instruments. So fixed number of shares will be there. So when fixed number of shares, the market price may be different. So market price may different. So market price is different means risk is increasing. So when risk is there, the equity person means always risk person. So who is taking risk in company? The equity persons only. Here they provided some examples. So in this example, here one company is proposed some dividend in board meeting. So when will the shareholders will get the right to dividend? When the company's AGM was conducted and in AGM they are provided the shareholders approval, then dividend will the shareholders will get the right to dividend and only. So the company has obligation to distribute only when AGM was conducted. In AGM they are disclosed and approval was taken, then only contractual obligation will meet the financial liability. Then only they are liable to pay in cash. When pay in cash means it will become the financial liability. There may be some example for equity instruments. So equity instruments, non puttable ordinary shares, that is equity shares issued by the company, it is equity instruments only. Some puttable instruments, they if they meet requisite criteria and are not classified as financial liabilities, then also puttable instruments is known as equity instruments. Some instruments that impose on the entities an obligation to deliver to another party, that is pro rata on the net assets of entity only on the liquidation. So at the time of liquidation they need to pay in another party in pro rata of net assets, then it is financial. It is also equity. Some type of preferences, when there is repayment and distribution is at the discretion of the issuer. When the discretion of the issuer, it will become the equity. And some warrant and call options that are allowed to holders to subscribe for or purchase fixed number of non-puttable ordinary shares issuing entity in the exchange for fixed amount of cash or another assets. So warrants are also known as for equity only. Some preferences, some characteristics, how they classified. So here some based on definition of equity, some characteristics of such instruments. Let evaluate some typical forms of instruments that may be used, how they classified. So in balance sheet we have equity. After that, preference. So we are talking about preference here. So preference shares, here preference shares means is a class of shares issued by the Indian companies. So here class of shares, it will be issued by the Indian companies. Here the terms may provide for redemption at predetermined amount with fixed return. So the redemption at predetermined amount will be fixed return, which may cumulative or discretionary. So they have cumulative and discretionary. In determining whether the preference or in preference, they have two options. One way it may become sometimes financial liability, sometimes it will become equity instrument. If we see here some preferences, when option is available to discretion of issuer, it has become the equity, same like as based on that. And after that, we need to redeemable ventures. Redeemable ventures means at the time of maturity they will provide the option, they may go for the equity or they may ask for cash. So redemption at a specified date or redemption at the option of the holders. So when redemption at the option of issuer, it will become the equity only. But when there is redemption at the option of holder, then it will become the financial liability. So holders option, it will become financial liability. Issuer option, it will become equity. And redemption at option of issuer means it will become the equity instruments. When it will become a non-redeemable preferences. So non-redeemable preferences means issued to some foreign subsidiaries of our in related parties, foreign branches or foreign associates or foreign joint operations or foreign joint ventures. So these all are related party persons. So when we are issued to our related parties, then in this case we need to appropriate classification will be required for that right to attach them. So classification is based on the assessment of substance. So what is the substance of contractual arrangement? Then if it is meet the financial liability, we need to disclose in financial liability. If it meets the equity instrument, we need to disclose in equity instrument. So when distribution to holder of the preferences were cumulative or non-cumulative at the discretion of issuer. So issuer means it will become the equity instrument. And classification of preferences, equity instruments or financial liability not affected. For example, history of making distribution, or means we are last year or before year we are distributing some phases. So we need to classify same like us. So history is not a distribution because last year may change for this year. So we have issuers option this time or we have holders option. So we need to see the conditions and what is the intention to make distribution in the future also. We should not bother this. What we are doing now is the main important. If there any possible negative impact on the price of the ordinary shares of the issuer if distributions are not made. So because some restrictions of paying some dividends or ordinary shares if dividends are not paid, preferences, it is also another cases where amount of issuers reserves. So whatever the amount was issuers reserve and issuers expectations of profit or loss for a period, it is also not affected financial liability or financial instruments. So when preferential is classification, if you have any issuers reserve, it will not affect the recognition of financial liability or financial equity. And ability or inability of issuers to influence the amount of its profits or loss for the period. So whatever the company does not have profits for issuing, it will not also affect the classification. Here the contractual terms may determine the nature of instruments. So any historical trends or ability of the issuer does not affect the classification of an instrument. It may classify as equity or it may classify as liability based on the present situation. It will not bother about the history and it will not bother about the future. And here the distribution, whatever the distribution of preference. So a preference shares distribution other than terms of redemption of financial instruments, another important point for consideration is whether the company is obligation to make payment of dividend. So in preference we need to pay the dividend. So here the dividend is as obligation for that company. So if that obligation is there or not, and the preferences have cumulative or non-cumulative, where dividend are at the discretion of the issuer. So here issuer will discretion the dividend whether may pay or may payable, or when at it will be issuer's option, it will be equity instrument. So company may choose, so then it will become the equity instrument. When it has at the only at the time of liquidation we need to pay, then we need to assess some contractual obligation. So now we do not have any contractual obligation because we are going in a normal way. We should not have any liquidation problems, we should not have any going concern problem, then it will be equity. And if the contraction obligation is existed, means next year we do not have any contract, we need to close, we have liquidation problem, then it will become the financial liability. Here financial liability may need two components. One will be represented dividend or equity components represented, so it will known as compounded financial instruments. In one instrument, if you have 2 or 3 instruments are included, it will become the compounded financial instruments. For example, they provided one example. So one silver company is there. So silver company is there, it has issued irredeemable preference shares. So irredeemable preference shares, face value will be the 10 rupees and premium will be the 90 rupees. So total value will be the 100 rupees. So whatever they are carrying, the dividend will be 8 rupees they are carrying dividend. And however, this dividend is paid only when silver declared the off on equity shares. I think 25 pages. Okay. So silver limited declares dividend on equity shares. So here the company has option to issue dividend. So issuer has options. So here two characteristics, one is preference dividend and it is carrying dividend payable, and they will pay only when declared to equity. So for equity shares there is the issuer's option, means company's option, and preference shares are irredeemable. Now it analyzing the equity definition. So in equity definition we have equity only if it contains no contractual obligation to pay cash. So we do not have any obligation as of now. And when an instrument shall be settled on own equity instruments or its non-derivative contract, it will be settled only by issuing fixed number of shares, or derivative contracts that will be settled by issue of fixed number of shares or fixed amount of cash. Now in the above instrument there is no contractual obligation. First condition is deleted since face value is not redeemable and except in case of liquidation. And another one, dividend is payable only if company declare dividend on equity source. So the dividend for the company's equity shares dividend, it is the discretion of the company, so they may choose pay this year or not this year. So it is equity instruments. Next, after that we will see that contract settled in own equity but classified as financial liability. So when contracts are settling for own equity, but it will be recorded as financial liability when it will be a non-derivative contract. So in non-derivative contracts where the contract that will be settled in variable number of entities own shares whose value is fixed amount. So when fixed amount of financial liability, so here amount was fixed already, then it will be financial liability. And where in case of fixed number of entities own shares but right attaching to those shares is varied, so they are giving shares in fixed means market price may change, so risk is there. When risk is there, then it will become the here variable number of own entity shares. Here fixed number of own share contract will be there, and here whose value fixed amount is financial liability. Here amount was not fixed, means we will go with the market price. When market price means it may go up or it may go down, so risk is there. When risk is there, it will become the equity. Next, what is derivative contract? Derivative contract means a contract that will be settled in variable number of entities own shares whose value equals an amount based on changes in an underlying variable. So commodity price means derivative means what? Here this value will change it based on the underlying assets. So underlying assets may difference. And after that we have non-derivative contracts. to settle in own equity. For example, a company is there and it have CCPS, that is compulsory convertible preferential issued by its subsidiary. One B company is there at the rate of 1000 rupees and it has 1000 face value will be 10 and 990 will be the premium. Here the instrument CCPS means it will need compulsory, they will convert preference shares into one equity share. So here the preference shareholders will get the equity shares at the end of the 5th year, and such CCPS carry dividend at the rate of 12% per annum, payable only when declared at the discretion of B Limited. So here that subsidiary company will have the right getting the dividend. Here B Limited issued CCPS which provide for they have conversion into fixed number of equity shares, that is one equity share for every CCPS, and there is non-cumulative dividend. As for equity, if we see in equity, there is no contractual obligation to deliver cash or other financial assets as of now. Here dividend payable only when declared and hence at the discretion of the issuer, that is B Limited is the issuer. So there is no contractual obligation as of now, and they are converting fixed number of equity shares, and here the conversion into fixed number of equity shares means the definition equity instruments, they are also classified in such books of B Limited. So in the B Limited books it will be equity instrument only. After that, if we are going for variable number of shares, so one target company is there and he is borrowing from Jet Limited some amount 10 lakh rupee they are borrowing. They have settled arrangement issue certain number of equity shares, so they will use a certain number of equity shares of target company which value will be 10 lakhs. So same value, so loan amount is also 10 lakhs and where they will settle at 10 lakh, value will be 10 lakhs. So fair value to determine total number of equity shares to be issued should be determined based on the market value of the target or the future date. So now date entered, but they will settle at fair value. So when market value is there for the fixed number of equity shares, then the market price is going up or going down, there will be a risk, so it will become the financial liability in the books of target company. So three cases comparison will be there. So financial asset means what, financial liability means what, financial equity means what, equity. So in financial asset we have cash, and second equity instruments of another entity, it is financial assets only. So if you are invested any amount in another entity's equity portion, it also financial assets. And after that one, if you have contractual right, that is right to receive cash or another financial asset from another entity, then it is contractual right. And when you have contractual obligation, here you need to pay the cash and to the another entity, or you need to give the another entity and financial assets, then it will be financial liability. Equity means there is no obligation, contractual obligation is not there, and to deliver cash or another financial asset to another entity. And after that, to exchange financial assets or financial liability with another entity under conditions that are potentially favorable. So if you have potentially variable conditions, you are exchanging financial assets or financial liability, it is also financial assets. When you are exchanging in unfavorable potential conditions, then it will become financial liability. So if you are favorable, it will be financial assets, if you unfavorable, it will be financial liability. And equity means here the exchange to exchange financial assets or financial liability with another entity, directly they will entering, it is equity. Next, a contract that will or may be settled in the entity's own equity instrument, it is also financial assets. Here financial assets means financial liability means a contract that will or may be settled in the entity's own equity instruments, including derivative or non-derivative, where variable number of shares and fixed criterion is not met. And here there will be fixed criterion was met, then only it will become equity. Now scope of financial instruments. So scope of financial instruments means this is not that too much irrelevance, so I will not discussing now. I think it is better summary of transactions outside the scope of financial instruments. It is outside the scope. If you discuss that standards India is 27116, then we will get the clarity for that here. So we will leave that question.